sometimes good news is bad news, and that's really what we got on Friday morning. We got a really, really good jobs report, but that is probably bad news for those who thought that interest rates were going to go down.
That's right. Yeah, the number that came out on Friday with non-farm payrolls, I think, just shocked everybody. When I was looking at the Bloomberg numbers, they always publish the what different forecasters are saying. It was way outside of the realm of what was even thought possible.
We're about 200,000. It was kind of consensus, right?
It was, yeah. I think that depending on who you ask, they were looking for 175 to 200,000, and suddenly you get over like 330,000. That is an incredibly strong number. And previous months, those numbers were revised higher as well. So sometimes what we've had, like last month, you had a good number, but you could almost dismiss it because there were back month revisions lower. This time you really couldn't do that. But there were some weird things in the numbers, though. When I looked at the aggregate number of hours worked, that actually went down 0.2% for the month. So even though the headline non-farm payroll number was really high, the total number of hours that people worked in the United States actually fell.
Oh,
so there's some incongruities in there that I think the market is trying to really wrestle with. But like you said, anybody who is betting that the Fed is going to cut rates in March, maybe they need to roll that bet into something in May or in June.
Yeah, and that's exactly what you said. As you recall, you and I had that conversation a couple of months ago about what we think expectations were, and you thought they were going to kick the can down the road, and that certainly looks like the story. 3.7% unemployment and the participation rate at 62.5%. But wage rates are up, and that is a big part. When you look at the CPI, how it's formulated, CPI is built on a number of things, but wage growth is a big part of that.
Yeah, wage growth can feed into especially the service sector part of inflation, and that's been a big concern when we've looked at the breakdown of inflation into what part comes from goods and what part comes from services. During COVID, everything was moving up together, goods and services, but now a lot of the disinflation, so the lower inflation, has been on the goods side. The service sector inflation has been coming down, but very gradually. It's almost been at a glacial pace.
So you're talking about wages going up and unemployment rate going down. That really means the Fed does not have to lower rates, and that's what we're talking about. So if the Fed does not lower rates as expected, right, then people were thinking about lower mortgage rates and so on and so forth. That may not happen in March or even April.
Yeah, and I think that can actually explain a little bit of the market reaction to the payrolls number that we saw on Friday. Big cap companies did quite well, but small cap, especially small cap value, those were actually really struggling throughout the day. And I think part of that is just because when you have those smaller companies, they tend to be more heavily levered, also a little bit more geared towards U.S. consumers, so they're not quite as globally focused.
So the Fed will stay data dependent. So that is really looking in the rear view mirror. They won't look through the front windshield right now. So they'll stay data dependent, and we're going to have to look at how things progress going forward to make an assessment of when they will lower interest rates. So let's switch gears, Brian, and really talk about what is really driving the market. Here we are moving closer to those big numbers on the Dow and the S&P 500, and that is really broken down by a number of individual names, and we saw some massive news out of Meta.
Yeah, it was really interesting to watch Meta. For those who don't know, Meta is Facebook, basically, kind of the rebranded parent company, and they had some really good growth numbers for sales, especially from ad revenue. People have been a little worried about if consumers are pulling back a little bit, companies tend to pull back on marketing, which part of that is ad sales. And so kind of viewing Facebook, the ad revenue growth, as a canary in the coal mine. And that was a little bit stronger than expected. But the biggest news to me was the fact that they decided that they were going to start paying a dividend.
Right. And that's unusual for a growth company to come out and pay a dividend. Yep. And, you look at who was affected by that. Zuckerberg, who owns a huge amount, could get a dividend as much as $700 million a year just on his stock alone. So that will be a taxable event for that guy.
It would be, yeah. So instead of having it just kind of riding as far as he can just sit on it with the capital gains and choose when to actually realize those gains, when dividends are paid, right, you don't have any control over that. If you own the stock, you get the dividend. Now, I guess the saving grace for him, we don't want to cry for him too much, is that if it's a qualified qualified dividend, it gets taxed at a favorable tax rate. So it's almost as though it is a long-term capital gain. But he has to realize that every year. And I think Barron's was talking about how at the current dividend yield, that would be about, like you said, $700 million per year. And I guess that does more than make up for his $1 a year salary that he notionally collects.
Right, and he was getting beat up this week in front of Congress, but no tears at all for him. So other news that came out of individual names, Apple had a mixed report, and the energy sector continues to crank along.
Yeah, so with Apple, they have their continuing woes with China. That growth has really slowed, and I was really fascinated by hearing the reports from Exxon, Shell, these big oil companies where they're doing quite well from a revenue perspective. So even though we've seen this volatility in oil prices, Exxon, it was really fascinating because they made a ton of money off of trading. It wasn't necessarily just from selling oil. They are actively involved in the market as far as hedging and sometimes taking some speculative positions with their oil exposure. And they made a lot of money off of trading energy.
Yep. So let's recap what we just covered here in the last couple of minutes. Number one, good news is bad news. So we saw a good jobs report, which generally means that the Fed is going to delay in their interest rate cuts. That affects everything from what you're getting at the bank to the mortgage rates. And so we're going to have to continue to watch that. The Fed is data dependent, which means they're going to look back at the data. And by the way, not only did they look back just 1 month, they went and revised a number of months back.